Welcome to Common Curiosities Retirement, where we aim to help people learn financial strategies they may want to use in their own life, all while trying to avoid the intimidation or boredom of classic financial meetings. Here's your host, my husband, Michael Custer.
In this episode, we're going to look at a couple examples of your tax bill and what your tax return might look like for a married couple that is either at $120,000 of joint income or $200,000. It's very important that you know your taxes, I think, when it comes to financial planning, because when you're in lower brackets, you may want to use certain strategies and ideas as opposed to when you get into higher tax brackets. There's a lot of misunderstanding in the tax code in the United States. It's what we call progressive, which really is just a fancy way of saying as you make more, you get taxed at a higher percentage on that higher money that you make. I have the best success explaining it this way. Imagine it's like buckets of water. The first bucket of water, you get taxed on 0%. Once you fill that bucket of water, you start overflowing into the next bucket of water. So the first bucket of water is 0%. We fill that one up. Once it begins overflowing, it starts going to the 10% tax bracket. Once we fill that bucket of water up, it goes to the 12%. Once we fill that bucket up, it goes to 22, then 24, then 32, 35, all the way up to 37. We're going to look at a pretty basic tax return. We're not going to get too far into complex things. We're going to look at a very pretty common example of, say, a 40-year-old couple filing jointly. They're making either 120,000 or 200, and how I would look at it if it were me, because as you make more, there's different strategies you might want to consider as when you're making maybe in that 12% tax bracket. So, as we said, they're making 120,000. There's no dividends, interest, or anything like that. I just have them both making 60. It doesn't really matter who makes what. It's just the total when you're filing jointly there. So their adjusted gross income, because we're not taking any 401k deductions or anything like that here, is $120,000. They're taking the standard deduction, which is currently in 2025, $31,500. You can either take the standard deduction or the itemized, whichever one is bigger. You're going to want to try to take that one. Many people take the standard because it's very high. That gets taxed at 0%. So that's a very attractive tax rate. We like that. We want to make sure we try to fill that bucket up. So their taxable income is $88,500. That's the 120 minus the 31.5. Their total tax would be $10,143. Their marginal bracket. So when people ask what tax bracket you're in, they're usually asking what your marginal bracket is. What that means is the next dollar you make is taxed at your marginal rate. So you already filled up that 0, the 10, and now you're getting taxed at that 12%. The effective rate, essentially what you do is you take your total tax divided by your total income, and that's your effective rate. But then also on top of that, this is for W-2 earners, you have, and self-employed as this too, you have FICA taxes. So Social Security, Medicare, those type of things. That's going to be about $9,180. So if you're making 120, you're not doing certain things, so like deductions, you're looking at $19,323 in total tax there. So one I want to point out here is, if you remember from some other episodes, if you're in that 12% tax bracket and lower, that can be great. You can actually make quite a bit of money and stay in that 12% tax bracket. Like here, we're making 120 and we're still in that 12%. If you have long-term capital gains, you might be able to get a 0% tax on that. So that's where you can say, hey, I can get some income at a great rate, or maybe I start tax gain harvesting there. So these just shows you the more you make, you go to the next bracket. So that 12 to 22, that's a pretty big jump. A lot of people fall there. Seems like, I can't say this, it seems like they're aware of that. Well, go from 12 to 22. The government knows we might get a little higher taxes there. But one thing I wanted to point out is they can make about almost $8,000 and change before they start getting 15% on their capital gain taxes. So you want to be very cognizant of that. If you make a lot more, you can get into net investment income tax. We're going to skip that here today. Most people do like to look at this a little bit more. It's a little more visual than just numbers on spreadsheets, essentially. So this is saying the first 31.5 is 0. Then we fill up that 10%. Then we go to 12. We're very close to going to the 22%, but we still have about $8,450 in that 12%. Medicare is a big one. We're looking at 40-year-olds. If you're closer to 65, you want to be cognizant of your Medicare premiums. If you make too much, you can actually get a surcharge. So if you go over that 212, we'll skip that. Then you want to look at kind of what credits you might be eligible for. So these people, they're under pretty much all of them except the Savers credit, which is very rare to qualify for. So we would qualify for all these different tax incentives there. So let's now look side by side if they're making 200,000. So everything's the same except instead of 120, we're making 200. Adjusted gross income is 200. The standard deduction is still 31,500. Their taxable income is now 168.5 instead of 88.5. So their total tax is going to go up to we're close to 27,000 there. So we're almost at a $17,000 jump on that 80,000 in extra income. Now their marginal bracket. So what this means is they've gone through that 22. They filled that full bucket up. Now they've moved on to their 22% tax bucket. So the next dollar they make is 22. This is often why people sometimes get bonuses confused being taxed differently. It's actually typically taxed the same way. We've just already filled up the other taxes. So you owe kind of your full marginal rate on that bonus you're receiving. Their effective rate here, so it's 16%. FICA is going to be 15.3. So now their total tax goes to 42,000, almost 200. So if I show you the tax report here, we've gone through that 22. Now we're filling up. We've gone through that 12. Now we're filling up that 22. So how I would want to look at it, okay, in 22, it could be higher. It could go to 24, 32. It could go all the way up to 37 in some other taxes. Am I at the point in life where I'm looking for certain deductions here? So what if I had a kid? So some of these are like education credits. You're going to college or grad school or whatever, either me or my kids. We could be eligible for some credits. Well, if this is our income, we phase out or we're above it, so we don't get those. So maybe we need to look at, okay, well, where do we need to get to be under to qualify for that? There's this EV credits. Those are going away here soon. But you kind of I would want to look at where am I close and where, if it makes sense for me, where I could get myself under to qualify for some of these. So we go here and we say, okay, let's first look at if we have kids, because you get a tax credit for kids. So we make $200,000. Everything's the same. Our adjusted gross income, our standard deduction, our taxable income is the same because child tax credits, they're not deductions, credits. You first calculate your taxes, then it's like a 1-for-1 like gift card against your taxes, essentially. Or a deduction, you would take it first. So we have the same taxable income here, but we receive a $6,000, $6,600 to be exact, credit. So we have 3 kids. It's $2,200 a kid right now. So when we calculate our taxes, we were going to owe $26,898. Now we're going to owe $20,298. So those kids, they're expensive. I'm sure the $2,200 tax credit doesn't cover all the costs that they're going to be, but it's still a nice tax savings. So your marginal bracket's still 22, but your effective rate goes from 16 to 12. And then you're at 35,000 total with your FICA. Well, do I get credit for that against maybe those education credits or other credits? You don't. They're credits, not deductions. So you'd still be above the phase outs. And if you don't need these phase outs, then who cares? But if there's certain phase outs you think you can get, you might want to look at that. So let's look at one more example. Let's say these people have kids that are almost in school. And they say, okay, let's see how we can get our taxes down. We say, okay, we're still making 200, but they decide to put in 20,000 a piece to maybe a tax deferred account, most commonly 401ks, 403bs, those type of things. So they put in 40,000, so they're deferring this to their retirement years. And then instead of 200,000, they have 160 of a taxable income. Their standard deduction they still get that deduction, $31,500. So their taxable income's now at $128 instead of $168, so the $40,000. And their taxes go from $20,298 to $11,498. Their effective rate goes down to about 9. So they're deferring it now. They're not paying tax now. They'll pay it in the future. So for maybe over here, I might, if it were me, consider maybe I'm using Roth retirement savings where, hey, I'll pay my taxes now. I'm not going to take a deduction, but I want tax-free potential in retirement. Here they're saying, I might want to get down below anyways for maybe education credits. So then we look and we got our income down quite drastically. And now we're under that. I checked the right one. Yes, I did. So now we used to be up here. So we fill up the 10 to 12. We're in the 22, but now we got ourselves below. And so if we want certain credits, we have more of those to us. They also are good. They can make direct Roth contributions. That phase out is pretty high. So you want to be well aware there. I see the mistake where they're over, say, 246 or 236 in this year, and they're making normal Roth contributions. You phase out there. So there's all these little different rules with the tax code. Look, I think you want to make your tax planning coincide with your investment plan and your Social Security planning. Like it's kind of like baking, I guess. You're not going to just eat sugar. It's not, I guess I take that back. I guess some people do eat sugar. Remember Pixie Sticks? Like I used to eat Pixie Sticks where like you literally eat sugar out of a little paper thing and then they get all soggy. You got to like keep cutting it off. It probably wasn't very good for me at all, but now I'm getting distracted. You want to take sugar and combine it with, I don't know, I don't do good baking flour or something, or recipe. Like you're not going to just eat barbecue sauce. You might use chicken and rice and vegetables. I think the same needs to go true with your financial plan. Don't just look at investments alone. Don't just look at the tax alone. Don't just look at estate planning or Social Security decision. You want to make sure it coincides kind of all together, because otherwise you start missing little gaps here and there, which I see as potential opportunities. Coincide it all together where, yeah, maybe we want to get certain deductions to get under a certain level. But at the same time, we don't want to get too low of tax brackets every year, because then our future tax bomb might be quite scary. So you want to find that right balance for you and your family of how much tax deduction do I want now versus can I get tax-free money in retirement? What about capital gains? All those things should go together to try to craft your plan. Don't just look at it one piece at a time. I think that's it. We went kind of long. Hopefully you found this helpful. See you next time.
Let's make sure we're on the same page. This is general educational info, not personal advice. We don't know your goals or financial situation. Before making any decisions, it's always recommended to talk to a qualified professional who can tailor guidance to your specific needs after learning more about you. Here are some more exciting disclosures to help make this even more clear. This information is not intended to be a substitute for specific individualized tax or investment advice. Securities offered through LPL Financial, member FINRA/SIPC. Investment advice offered through Harborfront Financial Group, a registered investment advisor. Harborfront Financial Group and Custer Financial Advisors are separate entities from LPL Financial. Investment advice will only be given after a client engages our services by executing the appropriate investment services agreement. Harborfront Financial Group DBA Custer Financial Advisors CFA is a registered investment advisor RIA. Registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. Custer Financial Advisors renders individualized investment advice to persons in a particular state only after complying with the state's regulatory requirements or pursuant to an applicable state exemption or exclusion. All investments carry risk. No investment strategy can guarantee a profit or protect from loss of capital. Past performance is not indicative of future results. Advisory services offered through Harborfront Financial Group, CRD number 331763,